Good morning, guys. Microphone check. Testing 1, 2. Microphone check. Testing 1, 2. There we go. Well, there's just a couple of us in here this morning. So if you have any particular questions you want me to address, this is a good time to get it done because it's just the three of us this morning. I was listening to a DJ called Akira the Don, Akira the Don, and he converts podcasts into audio-visual productions. And he's got a really nice one by Jocko Willink, the former Navy SEAL commander, who is a motivational speaker and a leadership person. And on his call-in podcast, some folks asked him, "Hey, what do you do when you're faced with challenges that don't go your way?" He says, "You're going to say good. We didn't get the funding for our project. You're going to say good. Now we can make do with what we have and be more efficient. Hey, I didn't get the promotion. Good. I'm going to get better at my job and improve my resume. Hey, this guy said something bad about you. Good. Then I'm going to practice having a non-reaction to external forces." So Akira the Don takes that really powerful stoic style of message, which is concerned only with what you do to the stimulus and response of the world, as the only thing you control and the only thing that's worth doing. And he puts that to really interesting beats and visual support. It makes a really good soundtrack when you're working out or walking the dogs or taking a hike. So I can really recommend it. Akira the Don. So there's only three of us here this morning. We're going to say good. That gives us a chance to focus on what we want to talk about. So everything is an opportunity if you choose to see it that way. And it's a choice. Well, let me pull up the. There was one question asked. Base. And let's see, I was asked to look at oh, okay. I'm sorry, Betty. It's shown as under Lisa Majors. I don't know if that maybe Lisa was experiencing health challenges too. But I'm glad you could make it this morning. I hope you're feeling better. Let's see. So Betty asks, see if I can pull that up. Yeah, let's see. Okay, I think was this Betty or Lisa that asked that question? Well, the some folks Didn't see the link. So the link is in Patreon. I'll post another one there for next weekend as well. What I realized I could have done was just make it one of the daily, the same link as the Monday through Sunday link, but just change the time in the stack. I didn't figure that out until after I published it, so we'll get that going. Okay. So as I'm looking at my screen of attendees now, there's 7 of us in here, and we're all named Lisa. So I am Spartacus. So Lisa asked a question. So I've been applying the trading concepts to charts in various time frames. On the entries, when the baby dragon crosses the RL10 at the bottom before the PSAR flips, I've noticed a consistent early entry. And that's kind of what I was talking about last night, that modification, the trailing PSAR entry. But on the upside, the baby dragon and the RL10 often are on top of each other when the market goes sideways. So I continue to follow the PSAR. On the exits, I'm consistently exiting at the Bollinger Band mean, you ask Wu Wei. Can I talk about exits in the floodplain and so forth a little bit? Yeah, that's, yeah, well. Let's see here. So we get some kind of, I like drawing the dragon and the yin yang thing first because that just seems to be the controlling indicator or the descriptor. And that's going to establish something like a pretty important range for us to know. That when you're noticing your symbol of interest, you watch that dragon from a distance, and that's going to give you an important set of boundaries. So these little points right here, the belly of the dragon and the hump of the dragon, those are the statistically significant turning points when it comes to price. It may be that when price was moving up this stack, that you might have had a little bit of price action here that was above, that's above this actual turning point. But we're going to treat all of that as noise. We're going to say that the real turning point occurred at the hump of the dragon and also down here at the belly of the dragon. And that represents like the fast trend because it's the RL10. I mean, it's a simple moving average 10, I should say. So if we looked at that, the very center of that, think of that as the spine of the dragon. This is really like that 2-lane highway. And those dots in the middle, that's going to be a 10 simple moving average. And then we're going to notice that the on moves that are sharp, when the move is big and down, there was a time when everything was inside the river. So I'm going to draw the river as very narrow here. So the Bollinger Band mean is a SMA 30. And the spine of the dragon is going to be an SMA 10. So we can think of the dragon as the fast trend and the river as the slow trend. And this is a 30. And this little guy is a 10. So we're getting fast versus slow. So when there is some kind of trigger event, something happens in the market here, whether it was news or an intention or just a decision or an algorithm, and now all of a sudden you have the selling pressure that overcomes this weak buying pressure. So there was at some point buying pressure and selling pressure were equalized. They were normal to each other. So you were getting just a sideways action through here. And this thing is just cycling until some trigger event occurs in which now there's a preponderance of selling pressure. Or it may have just been that some of the buying pressure disappeared. And as a result of that, there's only selling pressure left. So for whatever reason, you got some kind of big downward pressure, selling pressure. And we said that what made a significant move was one frog box, because that's the definition of signal versus noise. At a frog box 1.0, we have the first non-noise move. It's pure signal that was in fact a downward move. So that's the harsh winter that creates the opportunity that when this thing does change, it made some move down to this level, all the way down to the frog box. When it makes that turn, and we're going to go back, we just count a reversion to the mean trade. That's what creates the opportunity to gain on the upside. Opportunity is created by the equal and opposite reaction of that first move down. Well, when you see that dragon has made that kind of significant move, you will also notice that the RL10 will be in the winter. Let me make that thicker. The RL10 is the price. That's going to come down until it can't go down any further, and then makes that little turn. And because the RL10 is a 10-period look back, but it uses a moving regression line, it's more adaptive and quicker to change than that simple moving average 10, which is in the middle spine of the dragon, right? So what we're really looking at is, at any given time, is that there is some distance between the spine of the dragon and the RL10, and wherever the Bollinger Band mean is up here, which is at SMA 30, then the SMA 10, and then the RL10. There's some relationship between those things. They pulled apart, like you're pulling on a bow and arrow. When those things were all together inside the river and everything was going sideways, all three of those things were in close proximity, and there's no differentiation. There's no opportunity to trade in between those points. So when you get an exaggerated pinch, that's why we play that Z3P, the Z3 pinch breakout. or the super pinch, because now the opportunity is implied based on how tightly compressed everything is. That at some point, some traders are going to start moving it. Some little trigger event is going to occur, and it's going to cause this thing to move. Now, we wait until this compression is at an extreme abnormally compressed. So we're not just because it's sideways, we're not interested in it. We're interested in it because it is sideways quiet channel to an extreme degree, to the point where the breakout now has the possibility to surprise a lot of people. We want people to be lulled into such a feeling of normal security on that sideways that now the breakout becomes significant. So we're waiting for an abnormal sideways quiet channel. So then the breakout occurs. Well, if we didn't get the breakout, then one of the things we're interested in seeing is, did it get down to a full frog box of a sell-off? If so, I have a signal that that was a directional move that made it clear that the bears won. And then this thing is going to continue to go until it no longer does. And then at some point, at some turning point, enough buying pressure came in because they were attracted to getting quality on sale. And now they've stopped it from falling, and now it's put in this little baseline, a little temporary support level. So on a significant move, you will see this real separation between the RL10, the SMA10, and the SMA30. The river is slow to respond. What's really slow to respond is that RL270, that long-term fair value. That's really slow to respond. And so the difference between the RL10 and the RL270 is where we get that regression line fractal framework, which sees the difference between the trader's price and the long-term fair value of the two RLs. So that's another way that we can estimate, is this really an opportunity, the difference between the RL270 and the RL10. Well, when we have this big strong move to the downside, we also will see the baby dragon find his little space in here, and he's a moving average 3, simple moving average 3 of the RL10. So it's a simple moving average of the last 3 dots. So when you take, if those were the last 3 candles, the moving average of that is going to be where the baby dragon is. So he's going to parallel on a long directional move. You'll see now the RL10, you'll see the baby dragon, you'll see him south of the mama dragon, you'll see that south of the river, and everything is orderly until you get some turning point. And now in this moment here, when the baby dragon is going to slowly turn, and the RL10 crosses the baby dragon, that's where you have that significant alert. It tells you, the truth just changed enough that it may no longer be this downward move. This may actually be the thing that's going to go up the stack. And sometimes that move happens so fast that as we're watching our final little piece of this puzzle, that all the way down you had these PSAR dots that are usually this side of the, mathematically, this side of the dragon. And then when you had this this horrible sell-off, the harsh winter, and then the turning point, you're going to see on a long reversal trend, this long orderly move of the PSAR is going to go up. So one of the things that we look for, usually the last piece of the criteria, was the PSAR flip from here to there. And we said there were enough times when that move was so strong that if we waited for the RL or the PSAR to flip, then we were only getting in up in here, because it took some time for that price to pull the RL10 from the winter into the spring, then to cross the dragon, and then the PSAR to flip. Then and only then could we get our entry. And then our risk box was from the entry to the PSAR. So there's our risk box, and then, how fast can we get that thing to no lose plus dinner for two and lock in our little science project of gains. So if that was our entry, now suddenly that no lose plus dinner for two gives us this. So by keeping that stop in place at the original PSAR, and then like a sniper moving that up, that's what we call the Wu Wei effortless action stop. And then we kept that stop in place until the Bollinger Band mean, which by this time would have reversed. This Bollinger Band mean would have swung down somewhere in here and then started to slowly reverse. So in the Wu Wei exit, when we move it up, then it comes and catches the Bollinger Band mean, and then off it goes. That's the Wu Wei exit strategy. It features keep the initial stop in place. Then when the PSAR gets a couple, this is not drawn to scale, but as soon as we can get to no lose plus dinner for two, lock that in. Then when the Bollinger Band mean makes its turn, starts coming up, and it catches, then you can pick the Bollinger Band mean. And then you may also at some point want to, on a really nice move, you want to preserve a little bit more. So you take half the position with the sniper and half the position with the Bollinger Band mean. And that gives you the perfect, it solves the manager sniper dilemma by just taking half and half. And you end up getting a blended exit, and that is the essence of the Wu Wei. So I say all that now to say, well, Betty's question was, what happens if that's what happens down here at the southern turn? What happens up in here? Well, something else happens up in there. Because the move down is driven by fear, and this move up is driven by greed. So it is normal to see the move down look like one harsh, sudden collapsing dragon kind of a fail. But then the move up comes up in these little steps. And so if I were to draw this geometrically, the move down is this. Now it's not perfectly straight down, but it's steeply straight down. But then the move up takes a lot longer, and there are some of these little turning points, and that's why we often see that as leg 1, leg 2, and leg 3. And it takes those 3 legs to get back to where it was. In this case, that big sell-off which created the opportunity happens fast, and then the long-term fair value is this thing that it's finally going to get back to, but it takes a sharp sell-off and then 3 legs up, and So it's not symmetrical. It's not a V-shaped bottom. It's climb up the steps, fall out the window. Well, if you take a look at this kind of price action on this side of the curve, and compare it to the the price action on this side, on the sell-off, this very sharp downward move is what creates that real separation between, and a clear distinction between the RL10, that baby dragon, the mama dragon, the PSAR, and that simple moving average. You get a real clear distinction between those. But when you have this kind of grinding, price action, and you get up here near the top, it doesn't look so clean and neat. It's back in this, what's eventually going to look like a sideways quiet channel once it gets back to some kind of fair value, to the point where that river compresses, and then the Z3 lines come in, and then that super pinch is so tight that you can put a whole frog box between the Z3s, and now you have a Z3P. And now the breakout from that becomes like this again, and this, so you have an expansion, a contraction, a compression, and then an exceptional compression, and now you can start playing the breakout like a seed all over again. What you have to avoid is that after this thing has peaked, that you don't get chewed up as this thing is starting to compress. This is where that sideways quiet channel is a place to avoid. When it's just in normal sideways channel, that's where the crocodile river in the middle is just going to chew you up. So we like playing this long directional moves, and we like playing the breakout from sideways quiet channel, but we're going to avoid the sideways quiet channel. But we're going to wait till it's a Z3P to do the breakout, and that's going to give us some kind of nice move to the top, or a nice potential frog box move to the bottom. But if we don't get that, we can just wait for the next big frog box level of move to occur, and then we can say, there's the harsh winter that we needed. We needed that harsh winter, and that creates, then when the turning point happens and it crosses the baby dragon, this whole sequence starts all over again. So there's a nice impressionistic painting for you. So the questions in the stack here, while we're waiting for this to save. Let me answer some questions in here that derive from that last little bit. Did I look at using the Keltner channel? Yeah, so the Keltner channel is just a moving channel of a high and a low of a certain period. I was already using that with the NDX. Whoops. So I'm already using that with the NDX. And the Bollinger Band gives you volatility, and the NDX gives me price levels in a very precise, between 0 and 100 with very precise levels. So from the things that I use, I'm getting more than what the Keltner channel will give me, and I'm using both of these in a way that gives me real value. So I know that Keltner channels are out there, and that's, if you're comfortable using them, you can do that. But what I want to get is the combination of almost like a thermometer. I really want these that index scale, but I also want to see the expansion and then the contraction of the Bollinger Bands, so that I get an appreciation of what's happening with volatility, right? So the other question was, would the breakout include a squeeze? Yes. So there's kind of three phases of that. I want you to imagine the two Z3 lines. Then here's Z minus 3. And then in the middle is Z0. And that's the Bollinger Band mean. So when you have that price envelope, that price volatility envelope, what you have is when you look back 30 periods and you found the highest price, the math, it found the highest price and the lowest price, and there was probably some histogram distribution, and so the middle of the river is going to be that average. Hey, that's what creates that red dot in here on the simple moving average in the middle of the river is the average price of the highest to the lowest plus all these. So the mathematical average of those is what produces that Bollinger Band mean. And then when it computes, the standard deviation boxes, that's what creates the river is plus or minus one standard deviation. That means when you look at that totality of that price data, 2/3 of the price, 2/3 of those 30 bars fit within plus or minus one standard deviation. That's what the normal price was of the last 30 bars. So it's organized about 1/3 and 1/3. Well, the floodplain is Z2 and Z2. So that's Z1 and Z1, and that's Z0. So if 2/3 are in between Z1 and Z1, that means only 1/6 of those last 30 days can be found between Z1 and Z3. So there's practically nothing out here beyond the floodplain. So if I now took a vertical slice of this and rotated it and just treat this like the depth of the river, when you look at a river, it only gets as dry as it gets, bone dry. And then the average height of the river, fluctuates this much, plus or minus 1, plus or minus 2 is this. There is a floodplain that looks like this, where there is where that river, if it spills out, comes up to this lip. And now it rarely, almost all the time in this deep gouge that it's cut out through normal rise and fall, it cuts this river channel and it looks like a bowl. But infrequently, this thing will come out of that channel So if this is, whoops, if this little boundary here is z plus 1, that's the limit of the normal height of the river in which all the crocodiles live, where you're going to get chewed up. So if you're trying to trade in the normal sideways chop of the river, that's where there's going to be a lot of blood in the water because the crocodiles are going to get you. It's the breakout beyond Z1 that leaves behind all of this chop. The opportunity for the breakout begins to occur when price leaves the river. So as we define it, the beginning of trending behavior is when the RL, so you got the river, now the price leaves the river. So price was chopping around inside here, price was chopping around to such an extent that you got a sideways quiet channel. 10 bars when price, the RL10, which is the smooth price, and the RL30, which is the health of the trend, all of that is inside this tightly compressed river. And here's our Bollinger Band mean, our red dotted line right in the middle of that thing to remind us here's where crocodiles live. Well, the first thing that happens is that price leaves the river. And then the RL10, which was tracking price very carefully because it's a smooth price, then price follows pretty quickly. And you'll see that the RL10 follows the price very fast. So when that leaves the river, that's good. When price leaves the river, you might have a breakout. When the RL10 leaves the river, that's good. It doesn't become the beginning of trending behavior until that RL30, which is slower, also leaves the river. So when the RL30 leaves the river, all three of those conditions have occurred. This is the beginning of trending behavior right here. And as long as price in the RL10 continued to go up, that RL30 is going to lag because of math. And as long as this little combination of price and the RL10 is north of the RL30, everything is good. And now remember that little baby dragon is going to be in there. He's the 3-period moving average of the 10. And he's that first alert at the top of this thing. When he crosses, now suddenly that RL10 has rolled over. And now we got that first alert that all of this nice trend that was going up, we just got an alert that it crossed the baby dragon. And then if that RL10 rolls over, and now crosses the RL30, we have an RLX, or I'm sorry, we have the RLCO, regression line crossover. So if you've had a move from out of the river, that was one frog box, 2 frog boxes, but at least one frog box. This was a non-noise move. That RLCO is going to happen outside of the river, because the river is based on this 30-period simple moving average, which is very slow compared to the RL30. So now the difference between that fast regression line on a 30-period and the slow simple moving average is what tells you about the health of this trend. And then all of that excess gain that's in here between the RL30 and the Bollinger Band mean, all that is abnormal gains. That's excess value. And so now the sniper versus the manager exit. So the manager exit on that nice move is just tracking the middle of the river, and he's going to get the Bollinger Band mean. The sniper is proposing to try to get some amount of this, either from the very top or somewhere at the PSAR or at the skin of the dragon or something like that. So I have multiple chances to get a better exit with the sniper. Otherwise, I can just take this Bollinger Band manager's exit. So on these big moves down, so here's what I want to say. Now, the Z1 is here, and then the Z2 is up here, back on our river diagram. And if you look at rivers and hydrology, this is called the floodplain. The floodplain in agricultural history is this ground where all of the healthy soil and mineral and effluvium and things that have been washed down from upstream have all settled in here. And then when there's a flood and this thing is all churning, that pushes some of that soil and deposits this nutrient-rich soil up in here. And this is where all of the agriculture comes from, because most of the time this stuff is dry and it has that fresh fertilizer and rich soil. And this is where everything that's good in the world grows, because of that rich soil that's been deposited in the floodplain between Z1 and Z2. And it rarely gets beyond here, so everybody builds their homes outside of the floodplain, but near to the edge of it. because that's sort of like the high water mark of the floodplain at that edge of the Z2. But every so often, the 100 years flood gets out to Z3, and when it breaches the wall, man, this is where disaster comes in, because now that rush of water has come out of the riverbed through the floodplain, but now breaches the dam, or the what do they call that? The levees, and now washes away all of the civilization that has occurred in there. So any breakout of price that gets beyond Z3, wow. It's even rare for it to get past Z2. That's also a wow, but only two. So in fact, if we saw price moving up, and it gives us those two long dragon horns, and it's up here like approaching Z3, and it got up here past Z2 and out of Z1, that's a sign of an exhaustion move. It couldn't quite breach the Z3, and this thing's going to sharply reverse and go bang, 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 bang. So that's kind of an early alert that might trigger the sniper action to come in here and say, man, I'm going to take my sniper shot right now and capture some of this abnormal gains before this thing comes all the way back to the average down here in the river. So this little story time here, this little cave painting, talks about why Z1 and Z2 and Z3 really are important distinctions. This is not a linear function. When you take a look at the histogram of price action and how far things move from the mean, and you look at Z1, Z2, and Z3, Z1, Z2, and Z3 the other way, fully 2/3 of that price action is happening between Z1 and Z1. And only 1/6 is happening further out. Only 1/6 and 1/6. So this is really, although this feels really great, this is abnormal enthusiasm out here to Z2 and Z3. And this is abnormal fear out here to Z2 and Z3. And that's why when price moves from the Bollinger Band mean and it goes past the floodplain and out here beyond Z3 and starts to reverse, it's coming back to the Bollinger Band mean. This was really a statistically unlikely event in both of those dimensions. And that's why I never believe in that excess enthusiasm. That's what the 2-hour battle drill does, is to protect you against all of that. And I'm also going to say, I appreciate getting the questions in here like this, and sometimes you got to wait to hear these to get the questions. But if you can think about these things before this morning, I can prepare some other material for you too. So this is the point I wanted to make about, so under normal conditions, that Z3 line is like this, and the river gets kind of stable inside here, and you have the floodplain. I'll just draw that as here. And then your Bollinger Band mean is that little line. And under normal sideways conditions, you'll see price chopping around in here. I'm going to draw the RL10 as this brighter blue. You'll see the RL10 following that pretty nicely. And you'll see that RL30 slower oscillating, but everything is contained inside that river. Everything is contained inside that river. And ladies and gentlemen, that's where the crocodiles are chewing you up. Crocodile River is no place to be initiating trades most of the time. What we're willing to do on the supported spring crossing is see some kind of sharp breakout that went bang, one frog box, and created that harsh zone of separation. And that caused the RL10 to move way out and then to turn. And it was followed by that baby dragon in a nice, clean, orderly way until it no longer could. And then that tells you that run was done. And so we might measure that move. How many frog boxes was it? Maybe it was two. It has to be at least one for this to be the harsh winter. So when price is just oscillating around and then breaks out, that's the abnormal move. And then that thing comes back to whatever the, something like a fair value. It wouldn't surprise you to see the VWAP in here, the volume weighted average price. And when this thing occurred, the dragon left the river and then is going to slowly revert back up here. Well, when those things happen, the Z3 lines, which have been kind of like this, dramatically expand because of the volatility. And then as the volatility, as this thing starts moving back up the stack, that range starts compressing, and then you'll slowly see those volatility the Z3 lines begin to compress until the point where it just gets abnormally compressed. And then that Bollinger Band mean looks like this. That Bollinger Band mean probably looks something like this. Not quite drawn to scale. And you would have seen that RL10, oscillating wildly, and then, but slowly, it settles in on that new, better price. So these regions of tradability not tradable because this was like this period of declining volatility, not tradable. Crocodile River is starting to chew you up in here. These two regions are very tradable. Hooray. I'm gonna put that as a big green. Yeah, those are very tradable. This one's tradable because the downside move is going to feature like collapsing dragons in supported winter crossings. And this one is going to feature supported spring crossings and owls and continuation patterns. And let's just remember that this move down is sharp, and this move up here, once it's peaked on the bottom, this thing starts getting kind of choppier. So the sell-off is sharp, and then the grinding gains, 1 leg, 2 leg, 3 leg, and that's really the first leg of the next higher time frame, 2 legs, 3 legs. And that's why those turning points, which is the SSC and then the owl, and those measured steps up, that's tradable until the point where this thing starts grinding, and now it becomes this. So until those Z3 lines pinch so much, we want this to be abnormal SQC. This is SQC. This thing is grinding around, winning and losing, and then the net is very small. So there's not much follow through. That's where you get false breakouts and getting chopped up. What we want is an abnormal SQC. We want the SQC to become a Z3 pinch. Then we're interested in it when you can put one frog box. One frog box contains both Z3 lines. It's going to, by mathematical definition, going to contain the Bollinger Band mean, the river, and the floodplain, because those are all, they have to be inside the Z3 lines. So when that's just one frog box, look at this. You have these, the abnormal stretches are inside. That's all noise. Now, way back out here, there might have been 3, 4, an extreme case. There might have been 5 frog, that would be extreme. But there could have been 3 frog boxes between the Z3 lines. That's 3 full signal units. But by the time you get way up here into Z3 pinch, the plus or minus Z3, remember that's from that histogram that looks like this, Z0, 1, 2, 3. There's only a 0.5, a half of a percent is contained between Z2 and Z3. So an excursion out here to Z3 is extraordinary, but when they're so compressed so much, that's abnormal SQC. That means nobody is experiencing a breakout. That's why the breakouts from Z3 are so darn amazing, because everybody's been lulled into a false sense of security, and the breakout from Z3 after a Z3 pinch, that's what makes that thing so amazing in either direction. That's why when I'm looking for my minimum manageable risk box, I go to yesterday's most extreme Z3 pinch that was also you'll see it has to be sideways. What was the size of that box? That's how little that thing was wiggling when there was no buying or selling pressure. That's when it was idling. That gives me the minimum manageable risk box. And when that thing is in here like this and it breaks out, that's the beginning of signal. And off we go. And then my stop is at the other side of the Z3. Boom, no lose plus dinner for 2. Now it's a science project. And I'm going to pick up the Bollinger Band mean. And sometimes I'll pick up a sniper exit and a Bollinger Band mean. But what I'm keying that on is I didn't start trading that breakout again until it got to an abnormal pinch, a Z3P. Now, even better than the Z3 pinch is the super pinch. And remember, that is both the Z3 lines are inside a frog box, and the RL10, the RL30, the RL90, and the RL270. All 4 RLs are also inside that frog box. Now what you have is the absolute minimum of volatility, plus all 4 time frames agree that this is a fair price. the lack of volatility and absolute agreement that this is a fair price, that creates this little acorn seed. That's like a little radioactive acorn, and it can't wait to break out in either direction in a large way. That's the super pinch on every time dimension. Now, Grant asked me, do I use higher time PSAR for rejections? No. Have you ever seen me do that? No, I don't. I use the higher time frame regression lines, the RL 30, 90, and 270 to show me what's going on those higher time frames. That's all I need to see, because that's the fair value on those higher time frames. That's the RL10 on the higher time frames. So I don't need to go look at that chart. I only need one indicator to tell me where the traders at that time frame think fair value is. So this is going to be a little discussion on how this connects to the RLCO. So if I have price action, and I like to show it on the way down all the time. So if I have some kind of price action like this, and I have a 10 period look back, and I have a 30 period look back, and I have a 90 period look back, and I have a 270 period look back, multi-time frame. Now, if I'm on a 1 minute chart, then the RL10 is the fair price. It is the smoothed price of the last 10 periods. And that's the fast. And then the 30 period regression line is the slow. So if I looked at that price angle, I would see that in each last 10 period, right? So if I was chunking this back here, you would see that RL10, the average, the pure regression line price on that one is probably here. And that's why that dot is drawn right there. Because the regression line draws the best summary line, and it draws a dot on the 10th bar of the current price. It says that's where the regression line of the last 10 periods draws the perfect prediction of price, and that's why that dot is drawn here. And if I went back one time frame, I get all these little dots of each previous set of 10, and that's what that RL10 is. It's the moving regression line dot of the last 10 periods. Well, if I'm now looking at the 30 period line, though, that thing's going to be like right here. So the 30 period line comes over to here. And when I back up all the way past 270 dots, that RL30 is always going to lag. The slow regression line is always going to lag the fast regression line. until price starts moving up. And then you get that reversal, and now you get the RLXD. So that's what, on 1 minute charts, I'm looking at 30 minutes and 10 minutes of look back. The green line is looking at the regression line price of the last 90 minutes, and that comes down here and says, oh, here's where that price is. So now the RL90 is slower, and that thing is here. And the RL270, which takes into account all of this price action, is way up here. And so on a 1 minute chart, the RL270 looks back 270 minutes. But now if I dial that up to look at 3 minute charts, a 10 period look back is looking at 30 minutes. So the RL10 on a 3 minute chart is the same as the RL30 on 1 minute chart because of math. So the RL30 is the RL10 on 3 minutes. The RL90 is the RL10 on 10 minutes, which is really 9 minutes. But it's like if I was on a 10-minute chart, the RL10 would be where the RL90 is on the 1 minute chart. So this is fractal in nature. And then the RL270 is the RL10 on a 30-minute chart, because 10 times 3 gets you 30, 30 times 3 gets you 90, 90 times 3 gets you 270. So the 270-90 relationship is the same as the 30 and 10 relationship, but on a 10-minute chart. So when I see these different price levels, that's all I need to know about where those traders think fair value or the current price is. So I don't need any other indicator like piece. That's what those traders think that fair price is on the 10-minute chart. And that's where they think the trading price is on the 30-minute chart. And the difference now between the RL10 on my 1 minute and the RL270 is the difference between a 30-minute trader who thinks that's the fair value and a 1 minute trader who thinks this is the fair value. Which one of those guys is right? Well, when he runs out of money, it's going back to this guy. A 30-minute chart is still a pretty fast chart. Those guys are still trading compared to a daily chart. Oh, that's like many price levels up and much higher. So the fractal nature of these look-back periods allow you to see what's going on in the higher time frames. And that's like when the RL270 around lunchtime, it was a big sell-off, and then the RL270 starts rolling over. That thing is done. And then you'll see the RL90 will roll over a little bit faster. And you'll see the RL30 will have rolled over a couple times and rolled over. And the RL10 is really nervous in the service. So those multiple time frames, I'm not flipping back and forth between those charts a lot to get confirmation of this and that and look at it huge different. No, I've got plenty of indicators on how to manage the trade on my preferred time frame, whether it's 1 minute or 3 minute or 10, whatever the primary time frame is that I'm trading. The RL10 and 30 and PSAR and Dragon give me plenty of work to do, and I can just look at those higher time frames for broad general guidance without over efforting this. All right. So let me read the rest of your question. You're going to build a flashcard? Good. Build it and post it. So if there's a specific flashcard or a condition that I haven't described, show me a flashcard so I don't have to imagine what you're saying. And send that to me before Saturday so that I can prepare some good remarks for you and show you some case studies. Okay, so to get back to Betty's original question. I want to finish this up with the dragon. And I still owe the one question I did get. I haven't even answered yet. Oh my God, so horrible. When this dragon is oscillating around in between in the normal course of the river, under most conditions, you will see that dragon oscillating from side to side. And then when you get those sharp breakouts, you know, it starts like maybe as a fall. Oh crap. I hit the wrong button. It starts as a fall. This is the RL10. Then the RL10 became a harsh winter. That baby dragon was following him pretty close. And then winter became spring. The PSAR was following it down. Then somewhere in here, I want to try to draw it to scale. That's where we're going to get to. And so somewhere in here, you got that exit. Maybe you were using that, PSAR trailing exit. And there was your risk box, or if you got the accelerated one in somewhere in here, somewhere there's your risk box. That dragon, that from a distance you can see that thick orange side. And after these big moves, you'll see that distance between, um, the RL10, the baby dragon, the dragon, where it was on the Bollinger Band mean. So all of those things are connected. And you'll get that really nice spread pattern. It's when things start getting really choppy and you see the Bollinger Band mean and the dragon that's what happens inside here. On any given moment, the RL10 will be all chunked up in here, or the RL30 will be like that, and the RL10 will be in like this. And certainly the baby dragon will be all clustered up in here, and the PSAR dots will be flopping all over the place. That's the time that we're not trading. That's that sideways quiet channel. We're not trading that. You're waiting for an abnormal pinch to occur so that this thing can become a Z3P or a super pinch, ideally. Those are the times when you want to be trading. And then you get to experience that. Then it feels easy because it's range expansion. And then when this rascal works, you're getting the turning point. And then it takes longer for it to go up until those Bollinger Band means start compressing, and then no more sideways quiet channel. All right? That's what we're trying to say. So this is the period of time in these abnormal pinches or during these two big periods when there's a clear, decisive, unambiguous winner. In this case, the bears are winning. In this case, the bulls are starting to win. This is why this is my favorite time to trade, the collapsing dragon. So now I'm going to finish up with this one. Now somebody asked me for a flashcard on the collapsing dragon. That there's probably 20 of those inside the hybrid workshop themselves. You need to go through those lessons. And there's a flashcard or 10 in Campfire and in Base Camp. But in a nutshell, this is where you want to get to on your collapsing dragon. So there was some sell-off. Sorry, orange. And we enjoyed that nice big move. All right. And here's the RL10. So somewhere in here, we're getting our usual entry and our initial risk box. So that looks like leg one. The price was moving up and the dragon was moving up. And you probably saw the RL30. The RL30 may have been up in here, and there was like a RLCO outside the river or something like that. And then you notice the RL10 bottoms out, and it doesn't, and maybe here was the Bollinger Band mean, but it doesn't come all the way down here. The RL10 reverses here. So when you have this strong positive move, then the peak of the RL10 and the peak of the dragon, this is where you get the emerging dragons. And if you find the bottom of the RL10 or the bottom of the dragon in here, and now it reverses, there's a little pocket inside here formed by the RL10. And this is a legit entry right there. That's that quick re-entry. Using, the top of the dragon as your emerging dragon. You could also use, the RL10 can also work for you too. So you will usually see me using these as places to get second positions in because it failed to fail. This is failure to fail. It did not come all the way back down here. Now maybe the PSAR dots were in here, and maybe that PSAR hit, but then there's a rapid reentry, so I'm out and then I'm back in. Okay, but if it didn't even hit the PSAR, but came through the dragon and then took off, man, I'm right back in, or I'm adding that second position. The other thing it could do is it could end up coming down here. So this becomes a really crucial point. This is leg one from here to here. If this thing holds and goes up, then you're going to get another leg. This is going to be leg two, and the size of this move is the size of that move. But if this fails, it's going to come it could come all the way back. Now, the collapsing dragon consists of, on the very first trade that we took down here, that stop line that came across here from the piece where the PSAR flip was, if this price rolled over and fell below this line, then this is an automatic collapsing dragon, because the dragon turned, but then he couldn't, and then the dragon is going to turn and follow this price pretty fast because it had this big powerful downward move. It's going to roll over. So a collapsing dragon looks like this. That's the best pattern for me. This little space from the belly of the dragon to the peak of the dragon to a crossing of the previous belly of the dragon, that's the pocket. This is the emerging dragon. This is the collapsing dragon. The space between the hump and the belly, this whole region in here, is noise. I'm wondering, what's it going to do? Is it going to break out? Is it going to break down? I don't know. But once it breaks above the hump, dude, it's going. Once it breaks down below this, dude, it's going. This is where the opportunity and the question mark is. That's the pocket. This is the collapsing dragon. So what I want to see is, I wanted to like 0.1, 2, 3, 4. 1, 2, 3, 4. 0.3 is lower than 0.1. So the arrow is pointing down. This is the trigger line to the previous bend of the dragon down. That's why we draw the stop there on the SSC, because that's where the PSAR is going to flip, and we draw our risk box from there. That's where our risk box is, because if this thing is actually going to go, it'll never come back and test this. But if this thing is going to fail, this is the price level that told us that this ain't happening, that it's another one of these. Collapsing dragon. That's why the PSAR flip, and now it flips down to here. That's why that PSAR dot is so darn important. That's where the belly of the RL10 was. And usually that's a little bit lower than the peak of the dragon because of math. But that's why, because we're trying to get such a tight entry here, I like using the RL10 peak. So when we see this little move right here, look how much retracement there was, hardly anything.
That's just like a little train station to take on water and get a snack. Price was a big move up. It fell down and fell down and it resumed. So the fact that it couldn't get any lower than that and immediately took that out, that tells you the emerging dragon, and off we go. So this is the flashcard for the dragon, or that collapsing dragon. 1, 2, 3. That little, it's like a descending triangle. And then you just draw that horizontal line across and watch that thing collapse. I've said that approximately 1,000 times in the last 4 months. You've seen me where there was a nice big move up, and then it chops around inside here, and then you see where that, like a Z3 excursion or the belly of the dragon or the RL10, and then this thing collapses. Yeah, that's the collapsing dragon. Is that acts like a little shelf of support inside this, tight trading range. You start looking where did the dragon turn? Where did the dragon turn? And that's your collapsing dragon. All right? 1,000 times. So how many times on the way up should you go? Well, you see 1, you plan for 2, you hope for 3, because that's leg 1 of the other one. It takes these guys from the higher time frames to come in to give you leg 3. So if you have 1 little risk box and 2 risk boxes and 3 risk boxes and you're making those gains, that's good. When that thing no longer even gives you a risk box, when you get 2 scratches or 2 fractional losses, that run is done. Stop. Go find another target. Stop trying to make it work on the same symbol every time. No, because you're inside the sideways quiet channel where the crocodiles chew you up. Go find another symbol or go take a 30-minute break. Wait until you see a frog box adverse move. Oh, harsh one, and now you can play this thing all the way up. Stop over trading it. There has to be a reason for you to get in. You're not trading by default. There has to be some compelling reason to get you in. And it's a harsh winter, so you can play the rebound. You're not just going to trade that until the final echo dissipates. Yeah, when the general market turns, then all of the yeah, this stuff is fractal. Look, when the daily move was like this, it took 30 days for it to sell off, and then it took 90 days for this thing to get most of it back. It sold off that much and it got back. And so this move here was straight and powerful and dynamic, but now it's starting to turn and get sloppy and flat. So when the daily is doing that, that means the size of these moves here are getting smaller and there's less follow through. That means the swing trades are not easy. That's why I took the core position off here. And that's why I've not been swing trading much in here, because the swings have not been following through. I've been playing it 1 day at a time. So the daily chart and the risk Z tells you when you can afford to be swing trading and when you should just be day trading. So when the moves are not following through as much, you have to dial down and start going to a shorter time frame because the legs are not lasting as long. Or you just have to say, you know what, there's no follow through. I'm just going to wait. So the things that work in here don't work up there. That's what adaptive hybrid trading means. That's why you got to pay attention to the multi-time frame, multi-lens analysis. You got to go study the Walmart case study that I did Monday and Tuesday of this week, where we looked at the daily frame said you could trade if it broke above this line, then you could go long and you would get a nice intraday trade. But then the next day, Walmart gave it back. So what? I'm just trading the intraday trade. It gave me a critical state on a daily, and that tells me the intraday trade can make a nice move. And then I don't carry anything overnight. That's what core and turbo means. Listen to those lessons until you get sick and tired of them. Okay? That's everything I got. I'll get this thing posted. Look at August 2nd, the Walmart trade, Monday's trade. Go listen to the Monday trade and look at Walmart. That is a workshop all by itself. So things work until they stop working. And what we get paid to do is to figure out when there is a trend in one direction, when there's a transitional period, and when the trend has started the other way. This transitional period is hard. When it's trending, it's easy. That only happens 1/3 of the time. 2/3 of the time, the markets are non-trending. That means you have to dial down, or you have to trade inside the channel or inside the band at a lower time frame. That's why market conditions matter. That's why I look at the daily chart every day first thing. That's why I spend 30 minutes of each nightly strategy podcast looking at the daily chart and trying to frame the broad direction of the market to find out if it's in a critical state or if it has a trending behavior. That helps guide my intraday trades on the 30-minute charts, 10-minute charts, 3-minute charts, 1-minute charts. Those larger time frames provide information and key price levels as I build out all of those price levels. That's core and turbo trading. That's all it is. Thanks for your kind attention. Tomorrow night's podcast, we'll be looking at the any trade frames that you guys post. Okay? Take good care.